These are the two primary reports that we use to evaluate the financial activities of the business. So we've looked at these before, the income statement and the balance sheet. Income statement is also called the P&L or profit and loss statement. And so what we can see is all of those things that we've talked about so far are located on these two reports. So the income statement, we have all the money coming in, all the revenue. So these are just made up numbers. I just plugged in numbers and then double check the math to make sure that it actually worked out. But this is not pertaining to any particular business. So let's say that you had $125,000 in sales, and that could be, products, stuff like that. And then services, you actually performed a service for $100,000, et cetera, but you had $500 in returns. So then those are all of our revenue accounts. Sales, returns, and allowances, you see it's a negative $500. That is a contra revenue account. That's why we have a negative balance in there. Otherwise, every other account should have a positive balance in there. So if you ever were to log in and see a negative balance in your sales, something's off. Our net revenue after that is $224,500. Then we have cost of goods sold. So cost of goods sold, who wants to hazard a definition for that?
Cost of goods sold, basically COGS are what it took to basically make a sale. So if I'm doing a haircut, cost of goods is how much individually a single swipe of pomade would be.
Let's say you had a salesman in there that was like going around and selling different types of haircuts. This is a very absurd version of it, like a car salesman who's like, hey, you'd look really great in a pompadour. Let's say he's just inside of the salon. Like people are sitting in the chairs and he like walks up. He's like, hey, how you doing?
Yeah, well, commission would be COGS unless he's paid salary.
So in most cases, like,
it's I don't know.
Like in most cases, a salesperson is paid both the salary and commissions. The salary is usually pretty low, but they make more money in commissions because their objective is to sell. So if they went around and they were like, hey, you would look really great in dreads, then and somebody was like, all right, I'm going to do dreads, which I get is probably not a haircut you can just do, right?
Yeah.
For the purposes of illustrating, this is why I don't run a hair salon. If they were like, yeah, I'm going to do it, then the commission that you pay that salesman is a cost of goods expense, but not the salary that you paid the salesman, right? Because he's got to be there all day anyway, right?
It's an operating expense.
Yeah, I was going to say just an operating expense.
Right, exactly. So that's an example of how labor can sometimes be split between operating expense and cost of goods. So let's talk about you guys. If we were to elect S-Corp status, your salaries for performing managerial duties would be an operating expense because you got to do those regardless of if the business is open or not, right? You got to pay your sales tax. You got to fix the AC, et cetera. All of those things happen whether you're open or not. That salary is an operating expense. But if you're also cutting hair, then the commissions that you make on the haircut are cost of goods expenses. Make sense?
Cool.
So as we talk about building the model for Third Place, what you've expressed is that you're interested in having everybody being a W-2 employee. Do they make an hourly wage? No. So there is a requirement that you have to at least meet the federal minimum wage for the amount of hours that they've been there. So if somebody's there for 8 hours, they don't do a single haircut, you do have to pay them minimum wage for that, which is what, $7?
Is that only
$7.25.
Is that only required if you require them to be there?
I think that's
You
just
would require them to be there by the very nature of them being an employee. If they were a contractor, that would be different.
I don't think it would.
It's very unlikely that you would run into a situation where somebody was there and not making any money. Like whether you had, like an assistant, I think you would call an operating expense, not an.
So if we hired somebody right out of hair school that we're like, okay, you're taking clients now, they don't have a single client. They graduate hair school on Friday. They started with us on Tuesday. They have nobody. So it's like, yes, essentially we would have to pay that person until they have clients.
Yeah. Until their commissions brought them
Break over.
beyond.
Yeah, go over. Got it.
Yep.
Okay.
So the number after that is what we call gross profit, which is a pretty confusing term for a lot of people. This is basically just your sales minus your direct cost of sales. So your revenue minus your cost of goods sold is your gross profit. People can get this number confused all the time and they can be like, oh yeah, we made 500 grand in profit or whatever, but that's not actual profit unless it's the net income. Sometimes they're talking about gross profit, which means they're leaving out all of the operating expenses after that. This is just a good metric to see like what is your percentage there. Your gross profit percentage tells you how much it costs you to do sales. Revenue minus cost of goods equals that. And then if we divide gross profit by revenue, then we will see like what is our percentage of our cost of sales essentially. If you did 100 grand in sales, or let's say we'll take these numbers, 224,500, but let's say your gross profit was 224,000, and you'd have like a 1% gross profit, which means it's very expensive in your business to perform services and do sales. So this number is mostly just an indicator of like, hey, we should probably either increase our prices or we should try to decrease our costs there. Increasing prices is generally easier than reducing costs, but you also know that at a certain point, people aren't going to pay more for things. And you want to make things accessible and affordable. So it's always a delicate balance of those two things. You would say, wow, gross profit's $159,500. Like that's pretty good. But then when you realize that the expenses to run the business actually cost $118,000 of that, then the actual profit is only like almost 41 grand in this example. Negative numbers should only exist in that sales return and allowances. Even though all of these are expenses down here, cost of goods sold, operating expenses, etc., those are always positive account balances because the equation is to subtract. So we have our net revenue minus cost of goods sold equals gross profit, and then our gross profit minus our operating expenses equals net income. So if you have negative balances in there, it's not that it will never happen, but it's an indicator something's probably not right.